start. Let's move to a new topic, Forex. Move to a new topic, Forex. I have my own way of doing this chapter, so accordingly you'll have to shift around. You know that that's fine if you are doing for the first time. I'll be slower maybe in today's class. Get up the base work. Important from examination point of view, reason being this can be clubbed with the derivatives as it is Forex, international financial management. The different chapters can have link with this topic, so this chapter becomes important from the exam perspective. We consider this as complicated. In fact, this is the only chapter I think in which you need not even remember a single formula. At instant you have to create. That means this is one of the chapters which does not require to remember any of the formulas for the exam. It has to be self-created by taking some numbers. So exactly in the same flow I'll tell you that in exam if question comes, how would you think and create a question as well as the answer as well as the note. The formal part of the notes which we discuss during the class will only help you out to understand that these are the topics. Otherwise there is only one part I think which is bound by the law. That also institute will have to give the guidance, because you cannot remember the FEDI guidelines that automatic cancellation happens at what time, etc. So he will have to give it to you, anything which comes up. Ideally today we should have started with a chapter called derivatives. I would show you something in between whenever I get time, because that derivative you should know, get the feel of the chapter. But since we had spoken about the Forex, I'll do it the Forex part. First part of it is note numbers, you can keep giving it. When I start, the first part which we learn is how to read the sentences. For example, if I write $1 is equal to rupees 70, since both are currencies, this will give me a problem. Dollar is also currency, rupee is also currency, dollar can be a commodity, rupee can be a commodity. Means we cannot equate both of them as a price. One has to price, one has to be commodity. Whatever is on your left hand side and in one unit, we'll consider this as a chocolate. This will be treated as one chocolate. This I call it as left hand side, and that right hand side would be a price. So throughout the chapter, rule will be left hand side would be a chocolate, right hand side would be a price. What do we keep on the left hand side? What do we keep on the right hand side? That we'll see as we move forward. This can be termed as a direct quote. If I put this way, reverse way, 1 rupee is equal to dollar how much? It will be 1 by 70. If nothing is said, up to 4 decimals we can take, because yen is a small currency, so approximately up to 4 decimals we can take. It comes $.0143. Now in this case the term would be rupee. Do not get emotional about rupee please. Left hand side is a chocolate. One chocolate comes in these many dollars. That's it. These many dollars. The way of reading is, if I read $1.70, reading would be one chocolate comes in rupees 70. If I read 1 rupee as a $.0143, one chocolate comes in $.0143. If you want to remember by anything else, if you do not love chocolates, then you can remember rasgulla, rasmalai, etc. Anything of your choice. Left hand side would be a commodity, right hand side would be a price. During the day, we'll learn how to identify in the question that what has to be kept on the left hand side and what has to be right hand side. If you are able to make out left right, then entire chapter you will not face a problem which comes out. Second note, some slides I would have given it to you. This was first slide which was not shared with you. It is $70, one chocolate 70. Second is this. Now let's suppose if I have one chocolate as 70, one chocolate today comes in 70, we call that as a spot rate from the exam perspective, although spot rate has technical meaning of T+2, but from the exam perspective, spot rate means agreement done today, settlement done today. That means you will go to the market and say I want to buy a chocolate. Left hand side he'll say 70 rupees. Make the payment, get chocolate, that's it. Technically this is T+2 because there is something called Tom today, etc. There are a number of things. From the exam perspective, it is delivery happening today only. Now second part is, if spot rate is $1.70, and let's suppose 12-month forward rate. What is a 12-month forward rate? 12-month forward rate is the agreement is done today, settlement will happen at a certain period of a time after 12 months. If one chocolate comes at 75, now identification is one chocolate today comes in 70, the same chocolate after 12 months will come in 75 rupees. It means chocolate is becoming costlier. Dollar is at a premium. Chocolate is dollar here, dollar is a premium, dollar is appreciating, etc. We can use different languages. On whichever currency we will find premium or discount, that has to be left hand side, because only commodities or chocolates can get expensive. They can get expensive in the price term. For example, you will say the rasgulla has become expensive, the ice cream has become expensive. You never say the rasgulla has become fat, etc. It has become expensive in the price term. That means right hand side would be a price, left hand side would be a chocolate. If one chocolate today comes in 70, after some point of a time it starts coming in 75, we say chocolate has become expensive. Now let's read from the slide. Actually, first slide which would be there will be on premium discount. Just quickly go through it. I'll discuss with you the entire slide. Premium oblique discount, a very important part, please. Common mistakes we make, I'm saying in next 1.5 hours or 2 hours you'll be able to make out the mistakes you make. Then no matter which question you're doing, I'm saying it very frankly, I have experience maybe 15 years now. This chapter at least, I'm saying you need not require any formula to be remembered. Bond valuation, security valuation, mutual fund, derivatives, portfolio, everything will require a formula to learn. This is something which has to come instantly. If something says premium discount, it has to be whatever currency I'm calculating premium discount has to be in the left hand side, because the moment you start imagining both as currency, you'll 100% make a mistake. If not in this chapter, the currency derivatives 100%, because I cannot do currency derivatives without having that one commodity I'm betting on, and which commodity I'm betting on, that has to be taken a call nicely. Now if you look at this slide, I'll read out. When you go back home, just read these slides, you'll be very comfortable. I've tried to take the maximum number of slides, how to create the points. It says premium oblique discount. Spot rate is, it is rate at which transaction will take place today, exam perspective. Forward rate is rate at which agreement will take place today, settlement will take place after a certain period of a time. It is as good as you're filling your examination form, a forward contract. You enter into an agreement today, make a payment today, but exam you will give after some point of a time. So this rate is known today. Forward rate is also known today. Yes, we say if if one chocolate is 70 rupees, the chocolate will come in 72. So generally we call what is coming in 70 will start coming in 72. Chocolate is becoming expensive. How much rupee is expensive? 70 rupees becomes 72, 2 rupees expensive. If I ask you premium, or if I ask you how much costlier, you'll say 72 minus 70 by 70. Formula accordingly create, please. The formula becomes forward rate minus spot rate divided by spot rate. 72 minus 70 by 70, 2.87. Now dollar is appreciating. The different languages would be used in the question. Dollar is appreciating. Dollar is at a premium. Dollar is becoming costlier. Dollar purchasing power is going up. Mango people, Aam Aadmi. Aam Aadmi is not Aam Aadmi party, Aam Aadmi, mango people, general layman, mango people. Chocolate is becoming costlier. You'll only say what comes in 70 will start coming in 72. If one currency is at a premium, automatically second currency would be at a discount. It's but obvious, 100%. On whichever currency we find premium oblique discount has to be kept on the left hand side. It means if you're saying rasgulla is becoming costlier or chocolate is becoming costlier, chocolate has to be left hand side, price has to be right hand side. So what does it mean? If dollar is at a premium, it's a 100% guarantee rupee would be at a discount. Now if you have to find discount on the rupee, then rupee has to be brought on the left hand side. Look at this. 1 rupee would become equal to 1 by 70. 1 rupee is today coming in, and Rupee if gives discomfort, na, how can rupee be a chocolate? Just remember, left hand side is 1 unit a commodity. One chocolate comes in $0.0143. Forward rate was 1 divided by, sir, how did we write this? If this was $1 rupees 70, so opposite will become 1 by 70 and this will become 1 by 72. So one chocolate today comes in $0.043. The chocolate will start coming in 0.0139. Prima facie you can make up from here. What was coming in 0.0143 will start coming in 0.0139. It means the chocolate is cheaper. Chocolate in this particular sentence is rupee. So rupee has become cheaper here. Formula will not change. Forward minus spot by spot. Minus will represent the discount. Premium will not be equal to discount. The premium was 2.87, will not be equal to discount. It's a mathematical paradox you can calculate. For example, idea came down from 1840, 1350 today. How much is the fall? And it came down. I'll show you derivatives. I told you derivatives is something. How much percentage? How much? 26 percentage. Approximately 26. 6666. Now 63. Now try to increase 13.5 by 26.67. It will not become 18.4. It will not become 18.4. So to become, that means if general number I take 10 rupees, increase by 10 percentage, not discounting compounding, increase by 20 to become 12. If you decline by 20 percentage, it will be 9.6. That's called mathematical paradox. I think Siegel was the mathematician who recognized this. So we call it as Siegel's paradox mathematically. Premium will never be equal to the discount. 2.79 will not be equal to. If this was same, na, I did not have to do left and right. Simply premium is said calculate, discount is say calculate. In exam, out of 10 times, maybe one time, he'll generally assume premium equal to discount. So logically you have to take a call where he is using. Otherwise, if specific question comes on the premium discount or you have to calculate on the same, then please make sure on whichever currency we are finding premium discount has to be on the left hand side. So left hand side would be a chocolate, right hand side would be a price. It will not be same. This note is very important. So languages are, although devaluation, depreciation, these are not same terms. From the exam you can imagine the same thing, because some countries on their own can devalue, some countries have parity, they accordingly adjust. For example, China, there could be a possibility China can open up any relationship with the dollar. So we have a different meanings of actually devaluation, depreciating. Exam perspective, one and the same thing. We call it as rupee purchasing power is going down, because in 1 rupee you could buy 0.0143 and now you'll be able to buy what? 0.0139. So rupee purchasing power going down. This is economics language. This was second note. Second note was basically, if I summarize, left hand side would be a chocolate, right hand side would be a price. On whichever currency we find premium discount on the left hand side, and premium would not be equal to the discount. Third part is exporter importer, a very important slide again. This will help me in the main questions. In fact, the entire chapter, only two parties are there. One is exporter and second is importer. That's it. The entire chapter we have two people. The entire chapter we have two people, exporter and importer. Exporter is a person who will receive what? Foreign currency. He will sell. This is very important rule, please. I'll keep coming to it. And again I am saying, do not remember any of these slides. This is just to give you a comfort. In fact, when I am reading also, I 99% try to create new, because I cannot learn this. It's very difficult. Now how do I learn? Let's not look at this slide at all. Exporter is a person who has sold something outside India. It's a presumption in the entire chapter, unless and until in one or two questions is specifically mentioned billing is done in local currency. If you do billing in the local currency, then there is no problem of the currency fluctuation. For example, if you go to Qutub Minar and they say give us the rupee, there is no problem. If the foreigner also coming and they say ticket is 150, there is no problem with the foreign currency. But the moment they start collecting dollars, the fluctuation will matter. So entire chapter, only at one or two questions I think he'll say you do the billing in the local currency, that's it. Otherwise, billing is done in the foreign currency, whether exporter or importer. And since it is done in foreign currency, you have a risk involved because the fluctuation will be there. Risk in the financial management is not a loss. Risk is a fluctuation. It could be benefiting you, it could be making you lose something. So risk is a fluctuation in the financial management. Higher the fluctuation we have, higher the risk involved. Now let's speak about the exporter. Exporter is a person who would have exported goods. Funds would come from outside. Let's imaginarily create some examples. Let's suppose TCS. TCS is a export oriented company who do the billing outside India. 90% of the billing is done outside India. $1 lakh are supposed to come. So if $1 lakh comes today, let me assume some rate. If $1 is 70 rupees, if today they come, they'll convert to how much rupees? 70 lakh. If the rate after 3 months becomes 75, the moment rate becomes 75, what was coming at 70 will start coming at what? 75. Billing is still $1 lakh. That means I'll be getting more 5 lakh rupees. It means if the dollar was on left hand side, dollar was chocolate 70 becoming 75. If dollar is at premium, then exporter will gain. If the dollar becomes 65, then whatever 1 lakh is same 1 lakh. 1 lakh will come, which used to come at 70 will now come at what? 65. That means I'll realize lesser amount. The moment I realize lesser, that means foreign currency at discount. Chocolate left hand side is foreign currency now. Foreign currency at discount, the exporter will lose. So I can make my rule accordingly. If foreign currency at a premium, exporter will gain. If foreign currency at discount, exporter will lose. And home currency is exactly opposite. You do not have to remember the words also. So create the example automatically. Now when you say some of your cousins who are staying outside India and they are sending huge money, it's not that salaries have increased. It's the dollar which was $1.40 has become $1.83. So automatically, if they were earning $1 lakh earlier and now also they are earning $1 lakh, that $1 lakh when converted into Indian rupees, it is getting you extra 43 lakh rupees. So the currency fluctuation is playing an important role here. So the note, how do we create it? Note is created if $1 is 70, inflow will happen 70. If $1 becomes 75, inflow will happen 75. We call this situation as gain to exporter. And in this case, dollar is at a premium. So we say exporter gain is foreign currency at premium. Automatically, if foreign currency at a premium, home currency would be at discount. This is a gaining position for the exporter. Now, second is, in this case, we have 3 months time. That's $1 is at what? 67. If $1.67 we call it as what was coming at 70 will start coming in what? 67. If it comes at 67, we call it as foreign currency at what? Discount. Home currency at a premium. This will be what position? Loss. This will be loss to the exporter. This will come as a loss to the exporter. So this is the position we have. You can make the note accordingly. So the exporter will gain when foreign currency at premium. You cannot certainly remember under what circumstances. In exam, just simply take 30-second time. $1.70, $1 becoming 75. Now in this situation, is the exporter gaining or losing? And accordingly, you can make all the notes. Similarly, if it was an importer case, $1.70, he will need foreign currency, he will buy foreign currency. If he buys at 70, it's a 70 lakh rupees. If the rate becomes 75, he'll be buying at what? 75. That means if the foreign currency is a premium, it's a loss for the importer. So automatically this point becomes. So in this case becomes foreign gain would be foreign currency at discount. This is a gaining position for him. And loss would be foreign currency at premium. Automatically, since home currency works opposite of the foreign currency, we can make the note. So I write $1.70, $1.75. If today I buy the dollars as an importer, I need $1 lakh. My outflow would be 70 lakh rupees. If it becomes 75, same $1 lakh chocolates will come at 75. So this situation is basically foreign currency at a premium or home currency discount will give me a loss, and second position will give me what? Profit. Just quickly go through it, please. These will come very handy in the some of the bigger questions because he'll give the language. Exporter is fearing, importer is fearing. You should know under what circumstances he'll fear. So that language has to be crystal clear to you by making a note. Quickly look at the note, please. For the notes. First note was basically how to read. Left hand side is chocolate, right hand side price. Second was premium discount. Third is exporter importer. Fourth is again a very important note, which is the backbone of the chapter, quotations. This confuses to a greater extent when the deal is happening between bank and bank. So you have to be very careful when the language used. There are three people in which will do the deals between customer and bank, between bank and bank. Or if you are dealing with me, I am a seller, I am a shopkeeper. If I am dealing with someone else, I become a customer for the second person. The quotations are read from a seller's point of view. My language is very clear. The quotation is read from seller. Seller is between you and me, I am the seller. Between I and someone else, second party is the seller. So there are two ways in which, for example, if you go to some shop sometime and say I want to buy certain medicine and that shopkeeper does not have, he'll say wait for 5 minutes, I'll make it ready for you. He'll call up someone else. That means you are a customer for that shopkeeper, the A medicine shop. A medicine shop will call up B. B will become a seller for A. A will become seller to you. Between you and me, when the deal takes place, the deal takes place at a rate called a merchant rate. When a deal between a bank and bank takes place, it's called interbank rate. Quotations are from seller's point of view because one, I remember a question, Hong Kong dollar, everyone would be knowing it. Which question came back to back, I think 3 to 4 times in exam. Every time examiner comment came, student has made a mistake. Because the language should have been from bank and bank perspective and they were solving from our perspective. There has to be certain clarity on that. When we say $1 is equal to 65 and 68, two rates are there. For example, you go to bank tomorrow and tell them I want to buy $, they'll give you different rate. You want to sell $, they'll give you different rate. This quotation is written from seller's point of view. Imagine as of now, bank. You are a customer, I am a bank. It's from my point of view. The left hand side is bid rate or buy rate. That means I'll buy left hand side currency from you. The bid rate is the buying rate of the chocolate. That means I will buy, that's seller. Shopkeeper will buy chocolate from you at 65. Shopkeeper will sell chocolate to you at 68. The quotations are from the seller's point of view. That you can imagine as to be myself as a bank as of now. Bid rate oblique buy rate. Bid rate oblique buy rate is the rate of buying the left hand side currency. That is the buying rate of the chocolate. It's not from your. From if mine is buying rate, your is selling rate. Customer. So my is a buying rate means it's I will buy cheaper, I will sell expensive always. Sell rate or ask rate. Sell rate, ask rate is it is the rate to sell left hand side currency. That is the selling rate of the chocolate. Ask rate would always be greater than the bid rate. Difference between ask rate and bid rate is known as a spread. So this is quotation from my perspective. When you go to a shopkeeper and buy chips, he will sell you, let's suppose, at 10. And if you return back to him, he might not give you 10. Shopkeeper will buy, seller will buy cheaper the commodity and sell expensive. The difference between them is called a spread. Now same quotation, if I write, sir, in rupee term, 1 rupee is equal to dollar 1 by 68. Actually this was 1 rupee is equal to 65, 68. This will become this way, reverse calculation. Now 1 by 68, if I try to solve, would be in 4 decimal. Tell me how much do we get? 0.01 147, 0.0147, and this will be 0.0154. The ask rate would always be greater than the bid rate. Now why cross is done, understand also from a flow, because I might be using in some question. I don't know whether in this I have taken those questions or not. When let's suppose buying of a dollar, read from my perspective only, buying of a dollar, when I say I will buy a dollar at what rate? 65. Buying of a dollar is as good as selling of a rupee. Buying of a dollar is as good as selling of a rupee. So the cross currency comes accordingly. Selling of the dollar, if I sell dollar, that means if I am selling dollar, it is as good as I am buying what? Rupee. So buying of one currency is as good as selling of another currency, hence it becomes a cross rate, which will be seen in the currency derivatives. That when I go and try to buy something, if that language is not given, let's suppose I want to if it's bank, I'm saying bank has to buy dollar. So bank will buy dollar at 65. It's a bid rate. The buying of a dollar is as good as selling of the rupee. So that cross comes because of this reason. The rates quotations are from the bank's point of view. Now let's try to speak from your perspective. Let's suppose if this was given $1.65 and 68. This is a bid rate, bank will buy. This is a rate at which bank will sell. You are an exporter. If you are an exporter, you will go to the bank and do which kind of an agreement? You will go to the bank and say you will receive foreign currency, you will sell. You are selling, I'll be doing what? Buy. You selling, I'll be buying. Which rate I'll apply? 65. If you are an importer, you will be buying, I would be selling. If I sell, I'll be applying this rate. Customer will always end up paying higher. That's it. And bank will basically get margin. It cannot happen that I buy expensive and sell cheaper. It is always, as a banker, I will buy cheaper and sell expensive. So this will become this quotation. Now what to keep on what side, we'll take a call on that in the next note. In fact, next note is that on that only. Now I'll take up some example. Let's put down example 1. How do we decide what to keep on what side? Example 1. $1 is equal to rupees 60. Find $1 is equal to rupees 60. Find the amount of dollar required. Find the amount of dollar required by rupees 3 lakh. Find the amount of dollar required to buy rupees 60 lakh. If $1 is equal to rupees 60, find the amount of dollar required to buy rupees 60 lakh. Now when you solve this, basically everyone would be able to get 1 lakh as the answer, $1 lakh. Now please remember, in entire this chapter, whatever is a confirmed currency, confirmed is with whichever currency we have confirmed units mentioned. In this case it is rupees. We'll keep rupees on the left hand side. That means in this quotation the perfect way would be 1 rupee is equal to dollar 1 divided by 60. In entire chapter, whatever is a confirmed currency will be kept on the left hand side. That means it will be made chocolate. And entire chapter, whenever we'll move from left to right, we will multiply. Saying it again, confirmed currency would be kept. That means 60 lakh is confirmed here. I'll bring this on this side. Then I'll see what I'm doing with it, buying or selling. Confirmed currency kept on left hand side, left to right, we will always multiply. It means 60 lakh and left to right multiply is this sign. Since this quotation is coming this way, I'll put 1 by 60. This is actually, there's difference between this. If I put 60 lakh divided by 60 and when I put 60 into 1 by 60, answer is coming same, but the way of reading is different. Your institutes sometimes write this, they write without making any equation. We will not do any kind of a shortcut work in the forex. Confirmed currency to be on the left hand side, left to right would be always multiply. Since it is quotation 1 by 60, this will come 1 by 60. Answer becomes $1 lakh. Put down example 2 please. Put down example 2. Confirmed currency would be on the left hand side, left to right will multiply. 1 pound is equal to euro 1.4. Even if you know the shortcut, it's okay. You'll do the exactly same way. Find number of pounds required by euro 1 lakh. By euro 1 lakh. Confirmed currency, we call it as euro here. Confirmed currency is euro. I bring euro on the left hand side. My quotation becomes 1 euro is equal to pound 1 divided by 1.40. Left to right when we go. Left to right when we go is 1 lakh into 1 divided by 1.4. 1 lakh into 1 divided by 1.4. Multiply. This becomes how much? 71,420. So whenever we move from left to right, we will always do what? Left to right will always. Example number 3. Example number 3. $1 is equal to euro 0.90. Find dollars required by euro 1 lakh. Find the dollars required to buy euro 1 lakh. Confirmed currency is euro. Confirmed currency is euro. 1 euro is equal to dollar. First put 1 divided by 0.90. 1 euro. That means dollar required. Dollar required equal to 1 lakh into what? 1 divided by how much? 1,11,000. 1,11,111. Example number 4. Example number 4. $1, let's suppose 65. Case 1. $1 is equal to 65. Case 1. Importer needs to make. Importer needs to make a payment of $1 find outflow. What is a confirmed currency we have? Dollar. And dollar is a confirmed currency, and dollar is given as a confirmed currency on the left hand side. So my this quotation is right. When I put this quotation, it becomes $1 is equal to rupees what? 65. This becomes 65. Quotation is right. Now importer case, importer will buy or sell? Importer will buy. Bank will do what? Sell. If I am selling, which rate to apply? Sell, ask rate or selling rate 65. So rupee outflow. How much do we get? 1 crore. In the same example, make case 2. How many dollars will be received? How many dollars will be received if customer sells? How many dollars will be received if customer sells rupees 18 lakh? How many dollars will be received if customer sells rupees 18 lakh? How much do we get? Hmm? Now I told you, look up please. This is the quotation. Confirmed currency is given what? Rupee. Let me first put 1 rupee is equal to dollar 1 divided by 65 and 1 divided by 60. Now you check what is happening with it. Customer is doing what? Selling. Customer is selling. Who is buying? Bank. Bank will buy what rate to apply? Ask rate, bid rate. Your customer is language. Look at the language. Customer is selling. Bank will buy. That means the dollar would be inflow. 118 lakh na. Customer is selling. Bank would buy. And please make sure left hand side whatever is currency keep that only. How much do we get? 27,692. 27,692. Example number 5. 1 pound is equal to dollar 1.2 1.3. 1 pound is equal to dollar 1.20 1.30. Case 1. Customer need to buy. Customer need to buy pound 1 lakh. Find dollars. Confirmed currency is what? Pound. Make sure pound was on the left hand side. 1 pound is equal to dollar what? 1.20 1 point. Customer need to buy. Customer is buying. Who is selling? Bank. Which rate to apply? Ask rate. 1 lakh into what? How much do we get? 1 lakh. Entire Forex will make sure whatever is confirmed currency will keep it on left hand side. Left to right it this multiply. If division comes automatically put the division like this. This otherwise this has to multiply it. That's it. From left to right whenever we'll go it has to be multiplied. Fine. Now let's look at question number 5. Quickly read out please. Question number 5. Let me read out question number 5. Says an Indian importer. First line itself tells the expression. India is an importer. That means will need to buy foreign currency. Need to settle import bill for $1,30,000. So they will need to buy $1. The exporter has given Indian importer two options: pay immediately without any interest charges. That means they need to make a payment immediately without any interest charges in 0 period. Pay after 3 months with interest at the rate of 5%. Exporter tells him 1,30,000 plus you make a payment of dollar interest, and make a payment in how many months? 3 months. Or pay me immediately. Then when you paying immediately means if you don't have the money, you'll do what? You will buy dollars and make a payment. Buy dollars by taking loan in which currency? In rupee. You'll take a loan in the rupee. The importer charges 15% per annum on overdraft. Since you have been given 5% per annum here in the second case on the dollar interest, this 15% would be on what term, sir? Rupee. This will be applicable when you buy the dollars in the 0 period and make a payment. The spot rate he gives you, this is the way of reading this is rupee per dollar. $1 is equal to rupee 48.35, 48.36. The spot rate. Spot rate would be applicable if the payment is done today. 3 months forward rate will be applicable if the forward route is taken. $1 48.81, 48.83. So if the payment is done today, it will be settled at today's spot rate. If after 3 months, it will be settled at 3 months. Now diagrammatically, I'll tell you what exactly this means is. What exactly this means is, look up please. In diagrammatic, it's on slide number 6 I am on, just look up. The meaning of this is India is importer. Two options they have: pay immediately. When you are paying immediately, it means buy the dollar at spot rate by taking loan in rupee. Make the rupee payment 15%. Sir, how do you know 15% is on rupee? Because if one currency is given dollar as 5, then second 15% would be on rupee. And how do I know that he does not have money? If he would have had the money, then there was no need to make a payment after 3 months in the dollar. Exporter said two things: either give me the interest on the dollars and repay after 3 months time. That means dollar plus interest on dollars. Whatever dollar comes here, buy at 3 months forward rate. Second option he gave is pay me immediately. If we need to make him payment, we'll buy from the market. To buy from the market, I have to take a loan in what rupee? Take a loan in the rupee. Buying would be done at a spot rate. Since you will be buying, left hand side confirmed currency would be dollar, left to right multiply. You would be buying, I would be doing what? Selling. Which rate to apply? Ask rate. I will be applying a ask rate. 15% in rupee, and after 3 months repay rupee loan along with the interest. So two options are basically taking a rupee loan and making a rupee loan payment with interest, or carrying as it is the liability in the dollars and repaying a dollar liability. Do not compare 15% and 5%. We never compare the interest rate and tell which currency is cheaper or expensive. You'll come to know very soon. So we cannot make a call between these two. That sir, 15% is basically expensive than 5. Maybe in this answer it might come, but that is not the way out. Now in the first case, pay immediately. The rates are given to you. When I say pay immediately, the dollar to be paid is what? $1,30,000. You have a spot rate. $1 is 48.35 and 48.36. How much rupee loan will be required? Rupee loan required to buy $1,30,000 would be equal to 48.36 into what? 1,30,000. 1,30,000 into 48.36, that will be equal to 62,86,000. And you take the buy dollars, make the payment of dollar to the exporter. His work is done. And this loan, repay rupee loan along with interest after how many months? 3 months. So after 3 months when you pay, it's into 15 by 100 into 3 by 12. The rupee outflow is 65,22,000. 5. Second case is dollar, then make the payment along with the interest. You have a $1,30,000 plus 5% for 3 months, plus 5% for 3 months. Pay after 3 months. 1,30,000 has to be paid along with what? Interest. So this will be equal to 1,30,000, 1,30,000 into 5 by 100 into 3 by 12. This becomes equal to what? $131, 625. This will be paid at what rate? Forward. 3 months forward rate, 48.83 rupee outflow is this. Whichever option gives you least outflow. Pay after 3 months, since it leads to what? Less outflow. Quickly check please. Diagram only tells me how the presentation has to be done. This was a general question. Quickly check please. This was a very general question. Quickly check fifth question. This was a very general question in which two options you had: immediate payment or after 3 months. Now, next note I am moving to. In a general note I am moving. Let's suppose trying to buy a Apple phone. Your friend is coming from outside India and you ask him to bring Apple phone, and at that time $1 is equal to today's 83, and the costing in the dollars is 1000. How much phone will cost you? You ask him to bring today 83,000. Your expectation is this rate, what is 83, after 1 month time could be a possibility $1 will become 78. This is your expectation. Foreign currency at what? Discount. Chocolate, what big chocolate comes in 83, the same chocolate will come in 78. Foreign currency at discount. This 1000 is 1000 only. If you now ask your friend to send the phone, how much cost will happen? 78,000. Now if this kind of data comes and I ask question says, should you think of deferring the import of the phone, should you think the deferring the import of machine? But obviously there could be some plus minus, but prima facie by looking at the exchange rates, the one chocolate comes in 83. Since I have to buy, it's as good as making a payment in chocolate, and the same chocolate will start coming in 78. Should I defer the payment or defer the import of phone? Yes. Now note could be, in case importer thinks, it's an importer case, in case importer thinks foreign currency at what? Premium or discount? Discount. And home currency at premium. Foreign currency at discount, home currency at premium, he can think of deferring the import of machine. This data point. Now how the question can come? It has not come in your exam till now. There could be very high chance. Question number 2. Let's read question number 2. Management of Indian companies contemplating is thinking. Management of an Indian company is thinking import a machine from USA at a cost of $15,000 at today's spot rate of $1 is equal to 0.0227272 per rupee. Now it's very difficult to make out what it is. He has given 1 rupee is equal to $0.0227272. Now what I can do is, I can for my reference purpose put this 1.02272 72, and in rough I can know $1 is equal to how much rupees? 44. Now let's suppose if he would have given a $1 is equal to rupees 44, and he is bringing a machine worth rupees how much? 15,000. Even a 6th class student can tell you what total number would come. Something has to be extraordinary. He gave, instead of giving $1.44, he gave you 1 rupee dollar, but you know how to convert it. So you know, if you convert this 15,000, although confirmed currency was 15, but as per the question, what he has made is he has kept rupee on this. Anyhow, I have to bring dollar on what side? Left hand side. And when I move from left to right, I will do what? Multiply. The moment you multiply 15,000 into 1 divided by 0.0227272, it will be as good as 15,000 into 44. How much it becomes? 6,60,000. That means if you buy this machine today, your rupee costing would be 6,60,000, and you are an importer. You are what? Importer. Finance manager opinions that in the present foreign exchange market scenario, exchange rate may shoot up. Underline this line, please. Exchange rate may shoot up by 10% after 2 months, and accordingly he proposes to defer the import of machine. Now, rupee is also a currency, dollar is also a currency, both can be treated as commodity. He says exchange rate may shoot up. Now which exchange rate, which currency is shooting up, he'll think deferring the import of machine. No matter how much you try, I'm saying this is not the way of doing. If you're imported, you should think this way. Put any number. $1 is equal to, put any number of your choice. Any number of your choice. Put how much? Any number. 50. 50. Then $1 also put what could happen. Any number of your choice. 70. Any 70. Now, if you buy today, how much costing? This you've taken 60. Okay. If you buy after some time, 70. Would you defer? No. Now instead of 70, if it becomes 40, yes. Now tell me which currency is shooting up? Which currency is shooting up? In this case, when you will defer? 60 becoming 70 or 60 becoming 40? 60 becoming 40, you will defer. Now dollar is at what? Discount. Automatically which currency at a premium? Rupee. That means which currency is shooting up? Rupee. You have to make the note accordingly. I am telling you, even if I dictate the note, you will not remember the exam. Some of you might say, sir, he gave 1 rupee is equal to this $0.0227272. Hence, he would be talking about rupee only. If I was setting a paper, I would give you $1 is equal to this and still give you the same language. I'll still give you the same language. It's you who has to apply a brain that which currency is shooting up, importer is benefiting. So which currency is shooting up, importer is benefiting. Exactly same thing I spoke to you in that Apple phone, that if something is coming in 83 and start coming in 78, dollar purchasing power is going down. Dollar is a discount, automatically home currency at a premium. Shooting up means home currency at a premium. Maybe for the sake of simplicity, he gave you 1 rupee is equal to this because he wanted on whichever currency we find premium, discount has to be kept on what side? Left hand side. That is why he might have given. So in exam there could be a possibility you apply just 30-second time take that which currency is shooting up, importer is benefiting, which currency shooting up, exporter is benefiting, and so on. This was importer case. Importer will benefit when home currency shoots up, and that is only when I'll defer the import of machine. It means he is talking about rupee here. And 10% when he says, that means his expectation is one chocolate today is 0.027272. His expectation is 1 rupee will be equal to $0.02227272 into 1.10. 1 rupee is equal to dollar what? 0.024. Right? Exactly same number. 99. Now you show it to any one of your choice. Call any person from outside, from your home, from nearby bank, and tell him this is the rate today and this is the rate expected. Tell me what is happening. He will not be able to say. Your job is always try to convert. Why rupee on the left hand side? Because Whichever currency we find premium discount was on left hand side, it's okay. It does not tell us that you cannot reconvert. I'll put $1 is equal to what? Dollar 0.024999, and in bracket tell me how much it becomes. 40. And now you can call up anyone, say today $1 comes in 44, and after 2 months dollar will start coming in 40. Should I defer the import of machine? Yes, I should defer the import of machine. Exactly same thing is saying. Again, I'm telling that you might feel that sir, rupee was given the left hand side, that why he was talking of rupee term. It's not so. If I was setting a paper, I would give you this currency only, and language I'll keep the same. You have to apply a brain that which currency is talking about. That means he is talking about rupee shooting up after 2 months. That means today if he makes a payment, he'll make 6,60,000. If he defers the import of machine, then his outflow would be 40 into 15,000. That's 6 lakh. Gross saving is 60,000. And then he says management thinks that deferring the import of machine will cause a loss of what? 50,000. 60,000 saving, 50,000 loss to the company in the coming 2 months. As a chartered accountant, you are asked to express your views, giving reasons as to whether the company should go in for purchase of machine right now or defer the purchase. So the net benefit comes as 10,000. You can think of deferring the import of. Now check this out. Question 2. Importer can think of deferring the import of machine if home currency is at a premium, and in our case home currency is rupee. If rupee outflow, if machine is purchased today, rupee outflow, if machine is purchased today, it's $15,000, which is a confirmed number, freezed number. 1 rupee he gave, I put $1 so that I know exactly how much it comes. 1 rupee required to buy $15,000 is 15,000 into 1 divided by this left to right, 6,60,000. Rupee outflow if machine is purchased after how many months? 2 months. Expected rate would be left hand side we keep the currency on which we find premium discount. Since rupee is at what? Premium. So it will be 0.0227772 into 1.10. It becomes $0.0249992, and if we reconvert, it becomes equal to 40. Left hand side, left to right, when we convert 15,000 into this will give me 6 lakh. We say if we buy the machine today, it will come in 6 lakh 60. If we defer for some time, it will come in 6 lakh. Deferring will give us saving of 60,000. But since there was loss due to opportunity loss due to deferment, net benefit is 10. It is advisable to defer the import of machine since it leads to net gain of what? 10,000. Quickly check. This question can be expected soon. The exam. Long time this has not been. Quickly check it out, please. Question number 2. Next would be on the hedging. Once you've done this, Now next is on the hedging part. Taking again the importer case only, some numbers. Spot rate is $1 is equal to 70. It means if the importer needs to make a payment, his costing would be rupees 70. He wants to make a payment after 3 months time. After 3 months time, and after 3 months there are two possibilities. Expectation is expectation is $1 can become 75. $1 can become 75. So basically, if today he is making a payment, it becomes 70, and if the dollar becomes 75, his rupee outflow will increase. Similarly, standing today 0 period 3 months forward rate, 3 months forward rate, that means standing today only bank is ready to do the agreement and tells that you can come to me after 3 months and can you buy from me dollar at 72. Can buy the dollar at 72. Now you expect 70 rupees which comes today in 70 will start coming in what? 75, and bank is ready to do agreement at what? 72. So this is called, should we take the forward contract or not? Forward contract is enter into an agreement with the bank, I'll come to you after 3 months time and I'll buy from you at what? 72. Should you enter into forward contract? Yes, that's called hedging basically. Hedging is not that your loss will go away. Hedging is reduction of the loss. In case you buy today, it's 70. In case you do not do anything, it's 75. Loss of 5 rupees. If you go for a hedging kind of a contract, that means if you do a contract with the bank today, settlement after some point of a time, your loss which was happening 70 to 75 will reduce to 2 rupees only. So under what circumstances importer and exporter will go for hedging? We call it as reasons of worry. What are the reason of a worry for importer and exporter? If I put here exporter and I put here word, there are two currencies involved. One is foreign currencies, home currency. This was importer case, so let's look at the importer. $1.70 becoming $1.75. Importer was worried or not? Yes. Which currency at a premium? Dollar, foreign currency. We say foreign currency increasing or at a premium, he would be worried. Or home currency decreasing is one of the same thing. If foreign currency is increasing, automatically home currency would be decreasing. He would be worried. Exporter case is reverse. If $1 is 70, if today money comes, that will come at 70. If the dollar becomes 65, you will have a worry because what could have converted today at 70 will start converting at what? 65. So we call foreign currency what? Decrease. Home currency what? Increase. These are the reasons of a worry. In question, he'll give you the language. He will ask you, should he go for forward contract or under what circumstances he go for under forward contract? When expectation is foreign currency at what? Premium. Home currency at what? Discount. Or home currency purchasing power is going down. These are the reasons of a worry. And if that is there, then he can go for hedging, go to the bank and take contract at 42. Loss will still happen, but the loss which should have happened from 70 to 75 will reduce to 70 to 72. The reason of a worry. And I'm again saying same numbers I'll keep copying and I'll keep trying to create my notes. That's it. It's not that something new I'll create. Same 70 I can create under what circumstances gain, under what circumstances loss, could be used for hedging, could be used for deferment. But once you create one part, automatically second part would be created. A foreign currency premium, home currency at discount. Let's read question number 20, I think. Out question 20. Read quickly, please. Number 21 from your side. Let me read question number 20. Says a company operating in a country having dollar as its units of currency has today invoiced sales to an Indian company, payment being due after 3 months of the date of invoice. India is the importer here. The invoice amount is $13,750. This is confirmed currency, $13,750. At today's spot rate of 1 rupee is equal to $0.0275. It is equivalent to 5 lakh. If you want to see, you can see once also, convert also please. That means he is given today's rate is $1, 1 rupee is equal to $0.0275. It means $1 would be equal to rupee 1 divided by 0.0275. So we'll get some number here. If I put here 36 point, that means if we make a payment today, it's at the rate of 36.36. Second paragraph, it is anticipated. Anticipated, what you think? Exchange rate will decline by 5%. Underline this word. Exchange rate will decline by 5%. Now, two languages you can use. One was deferring, one was making payment, so there could be same languages. One could be a risk language. It is anticipated the exchange rate will decline by 5% over 3 months period, and in order to protect the dollar proceeds, importer proposes to take appropriate action through foreign exchange market. Now this is a worry language. This is a language which is of a worry, and importer would be worried. Now it's if difficult, which currency depreciating. One thing is for sure, exchange rate is declining. Now whether dollar declining or rupee declining, if it becomes, even if you try, I am saying by hook and crook you can remember, by chance you can remember, but no need to take a chance in the exam. Simply take two numbers, $1.70. If $1 is expected to become 75, is it a worry for the importer? Yes. Dollar is at what? $1 is 70. Expected is $1 becomes 75. I am just assuming rough numbers. Is it a worry position for the importer? Yes. Dollar is at what? Premium. Which currency at discount? Rupee. That means which currency declining he is worried? Rupee. Which currency declining? Sir, what is he saying? In order to protect dollar proceed, blah blah blah. I am not even concerned what he's talking about. I am not even requiring what he's talking about. His worry is $1.70, $1.65 is not the worry. $1.70 becoming $1.75 is the worry. That means dollar at a premium, rupee at what? Discount. Again you can say, sir, since he gave rupee on the left hand side, he was talking about rupee only. Again I am saying, if I am setting a paper, I'll give you exactly this first second. $1 rupee this. Exactly same language. Exactly same language. So you should know and take only two numbers. $1.70, $1.75, $1.60, $1.55, and then make your note accordingly. You'll be able to make any kind of a note of your choice anywhere. And even if you ask me, can I recall back that note which was written earlier? Maybe not. In exam, I'll make my note accordingly new. $1.70 becoming 75 is a position of worry for the importer. That means dollar at a premium, rupee at a discount. It means he is talking about rupee discount. That means he's worried that currency will decline by 5. That means he's worried rupee will decline by 5, and coincidentally rupee has to be on the left hand side, and he gave rupee on what side? Left hand side. That means he's worried whatever this rate he has given you, this first rate, this will decline by 5. That means anticipation is after 3 months this will become 0.0275. How much decline? 5%. Na? It's not proportionate because you've used over a 3 months period, so it's a 95%. That means he expects rate to become 0.026125. Again, with the naked eye you cannot even make out what exactly this means. So to convert and see what exactly it means is, I write for my reference purpose. Anyhow, I will have to bring dollar on the left hand side because dollar is a confirmed currency. Left to right I'll do what? Multiply. Although with rupee you are very comfortable, but do not change your rule. Confirmed currency is dollar. Dollar will bring on what side? Left hand side, and this is 0.026102. It's divided by 0.026125, and in rough I'll write this equal to $1 is equal to what? 38.28. If I give you prima facie this number now, today dollar comes in 36.36, and after 3 months it will come in 38.28. It's a worry position for you. It's as good as 70.75. It's as good as 70.75. Now he says it is anticipated exchange rate will decline by over 3 months period. Will get this rate, and then he says is the 3 months forward rate is quoted at 0.0273 per rupee. That means bank is ready to do agreement to you at today at what rate? 1 rupee is equal to 0.0273. Let us convert and see in dollar term how much it becomes. Roughly 36.62. You're required 63. You're required to calculate the expected loss and show how it can be hedged by forward contract. Now understand the meaning of it. If you would have made a payment, layman's language, general language I am using. If you would have made a payment today, your costing of the dollar was 36 rupees 36 paisa. If you do not do any kind of a forward contract, and whatever you expect that happens, decline in the rupee, then you will end up making payment of 38.28. Loss will take place. If you enter into forward contract with the bank, then you would be able to buy the dollar at what rate? 36.63. Loss will still happen. But if you buy it today 36.36, if you do not do any contract, it will come at 38.28. If you do the forward contract, it will come at 36.63. Loss can be reduced by taking a forward contract. That's the objective of it. The importer would be worried and take a forward contract when he has a worrisome. Worry would be when home currency declining and foreign currency at a premium, which comes out. Now let's look at it. Quickly read out the answer, then I'll discuss. This has come 5-6 times in the exam in different forms. Quickly finish topics. And I write exactly the way I speak so that it becomes clearer if you read this slide on your own also. It says India is importer will need $13,750. Rupee outflow if payment is made today. Rupee outflow if payment is made today. Spot rate 1 rupee is $0.0275. Since dollar is a confirmed currency, I have a habit of keeping on the left hand side. Left to right, when we go, we multiply. It comes 5 lakh, and that was given 5 lakh. Even if I do not solve, it will come 5 lakh. But just for my reference purpose, I wanted to check in today's term $1 is equal to how much? It came 36 rupees 36 paisa. If no hedging is done, no hedging done means do nothing. Expected rate after 3 months is rupee decline by what percentage? 95. 1 rupee would be equal to $0.026125, and that if I convert, always have a habit, whichever is confirmed currency I'll bring on left hand side, left to right I'll use this multiplication. Maybe as of now you are not able to appreciate rupee is coming. When the different currencies will start coming, you will start appreciating that left to right is one of the most crucial rules we have. Whichever currency is confirmed, I bring on left hand side. Left to right, I find out that if I do not take any action and actually rupee declines by 5 percentage, then what was the outflow happening at 36.36 approximately will start happening at 38.28. So in case the same $13,750, my rupee term outflow would be 5,26,316. So it means if no hedging is done, I was paying in 0 period 5 lakh, which will increase to 5,26,316. My loss would be 26,316. If hedging is done, bank is ready to do agreement at what rate? Hedging is done, bank is ready to do agreement at 0.0273. That means approximately 36.63. So still there would be loss. Rupee required to buy 13,750 would be 503,663, which is 3,663 higher than the original 5 lakh. That means my loss will still happen 3,663, but this loss would be lesser than if I would not have done this forward contract. So we say saving due to forward contract. Saving due to forward contract. Loss if forward contract is not taken is 26,316. Loss if forward contract is taken is 3663. Saving due to taking forward contract. Advisable to take a forward contract. Forward contract is one of the risk management tools. We have a money market operation, we have an option future market, so on. This is one of the tools of the risk management, which is the most common and easiest. 20th. Till now I've just covered the general questions. Now I'll start covering some technical parts of this chapter. What we have done till now is left hand side would be a commodity, right hand side would be a price. What we put on the left hand side is whichever is confirmed currency on the left hand side we'll put on the left hand side. It says $1 lakh, dollar is confirmed here. Pound 3 lakh, pound is confirmed here. Yen 40 lakh is confirmed here. Rupee 20 lakh, rupee is confirmed here. So whichever quantity he attaches the confirmed nature we put on left, then left to right we go and we multiply. Then comes the premium discount. On whichever currency we find premium discount has to be kept on the left hand side. If one currency premium, second currency would be at a discount. Importer exporter, no need to even remember the slides, just put down $1.70. Exporter, let's suppose $1.70. If it becomes 75, that means exporter will be benefiting. Today comes in it will be 70 rupees, after that will come 75. Dollar at premium. If dollar at premium, that means foreign currency premium, automatically home currency discount. It's a gaining position, and rest notes you can make accordingly. Then came the quotations. Quotation $1.6570 is from the seller's point of view. Seller is a person. Seller, between you and me, I am the seller. Now because I'll move into this topic very quickly after some 15-20 minutes. Between you and me, I am the seller. Between my and some other shopkeeper, that second person is the seller. We'll come to know. Seller will always buy, shopkeeper will always buy things cheaper and sell expensive. So rates are bid rate, my buying rate of the left hand side currency. Ask rate is my selling rate of left hand side currency. If we are reading the language from your perspective, customer, if you buy, importer buys, I'll sell. Ask rate. If exporter is selling and I'm buying, bid rate would be applied. That comes out. Now after that we have seen some general notes. Now we are moving to the cross currency. Let's put down important part of it. Cross currency. Cross currency. When you use something called A is equal to B, B is equal to C, you can mean A will have relationship with C. That means we are trying to say dollar has relation with rupee, rupee has relationship with yen. It means dollar will have relationship with yen to some extent. How we'll see that, we'll see in the single quotation and more than one quotation. Similarly, you can have A, B, B, C, C, D, three cross currency relationship. Now, simplest of the example I am picking up, example number 1. Straightforward, I'll move to the examples only without spending time here. Let's suppose $1 is 60 and $1 is again 100. Find rupee per yen. We read this as rupee per yen. Rupee is price, yen is chocolate. We are doing academic style. At the end, I might discuss some practical style. So in that chapter, we'll read this till the time I tell you. Rupee per yen. 1 yen is equal to how many rupees? Simplest way of doing this type of example is, we say left hand side is same. It means automatically right hand side will be same. Left hand side is same, right hand side would be same. That means uh, since chocolate is yen, we'll say if dollar are equal, left hand side is same, yen 100 would be equal to what? Rupee 60. That means 1 yen would be equal to point 1 yen would be. Example number 2, I'll put 1 pound is equal to euro 1.3, 1 euro is equal to dollar 1. Find dollar per dollar is a price here, yen is chocolate. First, we keep the quotation common currency equal. In this case, we'll put 1 euro is equal to pound, 1 divided by 1.30. Second quotation, euro is already on the left hand side. 1 euro is dollar 1.2. 1 euro is equal to dollar 1.2. So we call it as, since left hand side is same, that means right hand side would be what? Same. If right hand side would be same and we know the chocolate has to be what? Pound. We say 1 divided by 1.3 equal to dollar what? Equal to dollar 1.2. In this case, we'll say 1 pound is dollar 1.2 into, that comes some number 1.5. So if single currency is there, you will not have face a problem. Left hand side, you can make right hand side and right hand side. If you have more than one currency being given to you, if you have more than the ask and bid rate given to you, now please, right? Put down example number 3. Example number. Let me take one more small example. You do it yourself. 1 euro is equal to dollar 1.1. 1 euro dollar 1.1. $1 is pound. Find euro per pound. Confirmed currency is dollar. You cannot compare dollar is same, but since you have 1.1, bring dollar on the left hand side. Bring dollar on the left hand side and then do it. Things will become easier for you. bring dollar on the left hand side, it becomes easier for you. What we do is, from the first quotation I bring, since dollar is same, $1 is equal to what? One point. Now find out. Dollar is same, right hand side would be same. Left hand side dollar is same, right hand side would be same. And you have to bring this is euro per pound. Euro is price, pound is what? Chocolate. If this is same, right hand side would be same. What do you get? How do you get? What should I put? Pound 0.70 should be equal to what? Euro. 1 divided by 1 pound would be equal to euro 1.1.70. How much do we get? 1.29. 1.298. £1 is equal to euro 1.298. Now let's put down example in a two currencies I am taking now. Example number. In bid and ask rate, you cannot put the left hand side same. Let me put this way. $1 is equal to rupees 55. $1 is equal to yen 100 and 110. Find rupee per yen. Rupee per yen means is in 1 yen how many rupees comes? Rupee per yen. Now whenever you have a bid and ask quotation, always make synthetic rates out of them. So what does it mean? I'll put always $1 is equal to rupees 60.65. This will be read as rupee per dollar. Then I'll put 1 rupee is equal to dollar cross 1 by 65, 1 by 60. This will be dollar per rupee. And then I have $1 is equal to yen what? 100, 110. That is yen per dollar. And synthetic would be 1 yen is equal to dollar 1 divided by 110, 1 divided by one rate is given, second rate calculate. Accordingly, that means synthetic rate create. This is first rate given, create a synthetic rate. One rate given, create a synthetic rate. And then you need rupee by yen. Look up please. Rupee on the top. Rupee on the top is in the first quotation. Rupee on the top is in the first quotation. Yen at the bottom. Yen at the bottom is last quotation. Sir, once again, rupee at the top is in the first quotation. Yen at the bottom is the last quotation. Multiply first and last, you'll get the answer. Logic don't ask me as of now. We'll come to know the logic soon. Don't worry. Logic will come to know. Multiply just first and last, you'll get the answer. That's it. So when we multiply first and last, what does it mean, sir? What I need is, I need rupee by yen. Let's suppose bid rate, while multiply is equal to rupee by dollar, first quotation, into A by B into B by C. Bid rates. Bid rates are 60 into 1 divided by 110. 1 divided by 110. Logic will come to know very soon when I'll take the question. You'll understand from there. So my this becomes 0.0, 0.54, 5455, 5454, 5455. Similarly, you multiply the ask rates. Rupee by yen. Ask rate is rupee by dollar. It's as good as A by B into B by C. Ask 1 by 16 to 1 by 6. It's only simple 65, 65 into this is first one. Rupee on the top, first quotation will multiply and the last one will multiply. 65 into 1 by 100. How much do we get? 0.65. I have 1 yen is equal to rupee. How much? 0.65. 0.5455, 0.65. Two examples I have given in the notes itself. We'll discuss from there and then we'll see how the language comes and what is the meaning of this, sir. How do I read or interpret this language? I'll come shortly. Slide number 11 I am on. Slide number 11 I am on. Example 7 I am reading from here. 1 pound is dollar 1.2, 1.3. 1 euro is dollar 1.05, 1.10. I need euro by pound. First I'll do is nothing but I'll create what is given. To me was given 1 euro pound is equal to dollar 1.2, 1.3. The way of reading is dollar per pound. It's dollar per pound. Synthetic rate is basically dollar brings here $1 is equal to pound 1 divided by 1.30, 1 divided by 1.20. Then I have euro. 1 euro is equal to dollar 1.05, 1.10, and the cross synthetic is $1 is equal to euro 1 divided by 1.10, 1 divided by 1.05. I require euro by pound. How do I decide, sir, euro by pound or pound by euro? In question we'll understand. How do I decide whether it's euro by pound or pound by euro? Then once I make these four, which will be easier for every one of you, euro on the top is in the fourth quotation and pound on the bottom is in the first. So when we multiply first and fourth, we'll get the answer. First and fourth, that means to multiply 1.20 into 1 divided by 1.10, we'll get bid rate. Multiply 1.30 into 1 divided by 1.05, you'll get what? Ask rate. Quickly check this out. And then try example 8 also. Then try example 8 also, please. Try example 8. Objective is to convert into four currencies. As of now, we have just learned a mathematical process of it. Just learned a mathematical process of it. Once I'll go to the questions, we'll learn the fundamental way of reading these numbers. Once you're done, let me know. It was given pound is equal to dollar 1.2, 1.3, dollar is equal to euro 0.9.95. Find euro per pound, euro on the top and pound on the bottom. First and third quotation we multiply, we get the answer. First and third. Actually, if you look at, try to read also, what does it basically means is, let's suppose I want to buy the pound using euro, then I might have to first do the relationship of pound and dollar, and then with that dollar I have to go for the pound. Now let me take the one more slide, I'll discuss with you, then I'll move to the understand what does it. I am on slide number 12. Let's try to read this exchange margin. This slide will become very important when we do modification of the forward contract, cancellation and so on. This will come very important. We are trying to do with respect to some question here. Then we'll see in the modification of the forward contract. It says exchange margin. We have exchange margin. Let's suppose I am just taking an importer's case here, importer, and I have taken some number here to make you understand. If a customer goes to property dealer 1 and says I want to buy a property, property dealer 1 will call up a property dealer 2 and he says I want to buy some property. Property dealer 2 tells property dealer 1, I'll give you at 60 lakh. So dealer 1, when he is quoting a rate to the customer, he will quote at 60 lakh plus. It's importer case. Now importer customer went to buy dollar from ICICI Bank. ICICI Bank confirmed the rate from HDFC. HDFC gave the rate to ICICI $1.60. He will give you $1.60 plus. Sir, we will go directly to HDFC. You go directly to HDFC, you'll go to some other bank. So there is relationship between you and me, my and the bank. Between you and me is known as the merchant rate. That means whenever you will buy from me, you will buy, or I will sell basically. You are buying, I am selling. I will sell at whatever is my cost plus margin. No need to remember a formula. Whenever you buy a property, you end up paying margin. Whenever you sell a property, still you end up paying a margin. When you buy a property, you end up paying a margin, your property cost increases, add margin. When you sell a property, that means you sell and margin would be subtracted and then balance would be given to you, minus margin. Exporter case I have taken, you will sell dollar to me. I confirmed from shopkeeper that I have dollars, would you buy from me? He said yes, 65. If the second bank is buying from me at 65, I will buy from you at 65 something minus. That's 65 minus. Now logically, whenever in a question margin is given, you have to adjust for margin. If margin is not given, no need to do any adjustment. Second, between you and me, rates would be merchant rate. Between bank and bank, rate would be the interbank rate. Between you and me, quotations are from my point of view. Between me and someone else, quotation would be some different bank point of view. That means seller's point of view. So margin would be, in case it's a importer case, add margin. Its case it's a exporter case, subtract margin, comes out. Let me read question number 32. 32. Read out the question. Thirty-two. On January 28, 2005, importer customer, the word is importer customer, requested bank to remit Singapore dollars 25 lakh under irrevocable LC, the guarantee basically. So dollar SGD is a confirmed currency. However, due to bank strike, the bank could effect the remittance only on 4th Feb 2005. So the agreement was to be done on 28th, remittance happened on 4th Feb. They have given you January 8 interbank rates. It means rates are between the bank and bank. And Feb 4th. Dollar rupee relationship given, pound dollar, pound SGD. Now whenever rupee currency is given one, it is 100% guarantee one currency has to be rupee. He says it's an importer case and 25 lakh SGD given. Importer case 25 lakh SGD. And India will be rupee, nothing is mentioned. Rupee is one of the currencies, that means you are talking from the Indian perspective. Indian importer will buy SGD or will sell SGD, means he need to buy SGD and make a payment, or SGD will come to him and he will sell the SGD. It's an importer case. Importer will buy, need to make a payment. That means he need to buy SGD is a confirmed currency chocolate. With which currency we want to buy SGD? Rupee. That means we want to find rupee per SGD buying rate or selling rate. Buying from whose perspective? Customer. Customer will buy. I would do what? Sell. Which rate? Ask rate. So first I'll calculate interbank ask rate, that is between me and me, bank and bank, and then I'll add what? Margin. Margin is given separately, and then I'll calculate the answer. How much does the customer stand to gain or lose due to delay? So basically what we'll do is, if I take the January 28th rate, relationship is given rupee by dollar, second is given dollar by pound, and then it is given SGD by pound. Using these three quotations, I'll convert in 6 quotations, and I need to find what? Rupee per SGD. Once I get the rate on January 28th, since it's a ask rate, this rate will be a interbank market rate. The rates are between bank and bank. Once I get the rate of interbank rate, then I'll add a what? Margin, and find out what would have been the quotations on 28th January. Then what I'll do is I'll calculate what would be the rate on Feb 4th. Exactly same thing I'll do. Sir, how do we know rupee per SGD? SGD was a confirmed currency. Rupee is the Indian importer. Indian importer want to buy SGD with rupee. I have been given relationship for dollar rupee, pound dollar, and pound SGD. I've just written what is given. I need what is rupee on the top, SGD on the bottom. So basically using these, I'll convert this rate, synthetic rate, this rate given, synthetic rate, this rate given, synthetic rate I'll create. Out of those 6 rates, I'll try to find in which quotation rupee comes on the top and SGD comes on the bottom. Let me show you first case, then you can look at the second part. If I try to look at the number here, slide number 10 I am on, try to look at. Since India is importer, it means they need to buy SGD from rupees, hence we need to find rupee per SGD ask rate. January 28th, I was given $1 is equal to what? 45.85, 45.90. Then I used the inverted 1 rupee. I was given 1 pound is equal to $1.7840, 1.7850. I converted $1 is equal to what? How many pound? Pound SGD was given. I converted into 1 SGD. I need rupee on the top and SGD on the bottom. Look up please. So when I multiply first quotation rupee by dollar into pound by SGD, there is a problem which happens here. It's A by B. There are actually C, D. A by B and D by C by D comes. A by B and C by D. In between I need to cancel out this dollar and this. Actually what would have happened? With rupee he would have bought dollar. I need this third in between. Sir, what is the use of third and how do I read? If mathematically I see dollar will get cancelled and pound will get cancelled. Way of reading is, to buy SGD I need to know pound. To buy pound I need to know dollar. To buy dollar I need to know what? Rupee. See, how do we read cross currency? It is cross currencies. To buy SGD, how many pounds required? To buy those pound, how many dollars required? To buy those dollars, how many rupee required? It is as good as to buy SGD, how many rupee are required. Because when I wrote here rupee on the top, I could make out. In exam, don't apply any kind of brain, just simply see numerator denominator rupee into this, and when I multiplied into last pound by SGD, problem was dollar and pound were not getting cancelled, so I had to take help of between dollar by pound. So basically I used first quotation, third quotation and the sixth one. In this case it's A by B, B by C and C by D. So automatically B and C gets cancelled, it's A by D, the answer comes. In simple words, with rupee you can buy dollar, with dollar you can buy pound, with pound you can buy SGD. It is as good as with rupee you bought what? SGD. And this rate is 28 I found. So rate which came out was, ask rate I was trying to find 45.90, 1.785. How your institute write is, they write 45.90 into 1.7850 and directly divide. It is dividing only. But my way of doing is left to right we are going and we are doing what? Multiplication. So I have this multiplication which comes in 45.9, 1.7850 and 1.3575. We get 1 SGD as 25.9482. Actually this is my asking rate from interbank. Now since you are asking me, I will add what? Margin. I will add margin and give the code to you. Now in the fourth quotation, in the second, when you are calculating Feb 4th, you can make your life slightly simpler. Sir, how? Since you know you used first quotation, no need to write synthetic, directly write first. Then you use third quotation which was directly given in the question, no need to write synthetic, directly write. And last one you know sixth you used. So you can write synthetic and then do it. Once you know on January 28 you used which rates. So the quotation what you used was $1, 1 pound and 1 SGD. 4th Feb you can directly write these quotations and multiply. You will get the rate on the 4th Feb. 4th Feb becomes 26.0719. It represents that if you would have bought the SGD on 28th, your rate would have been 25.9806. The rate which you will get on 4th Feb is 26.0719. So loss would come accordingly. Quickly check the answer, please. Quickly check the answer. Quickly check out. The rate between bank and bank are interbank rate. Rate between the bank and the customer is a merchant rate. This question has come 2 times or 3 times in the exam. Next question which will cover has come 7 times in the exam. In exam, do not try to apply a lot of brain that what we are doing. Simply identify whether it's a rupee by SGD or SGD by rupee. How would you identify is, whichever is a confirmed currency that becomes a chocolate. If rupee is given, you will need to find rupee by SGD. Since you have to buy, you are importer, you need to buy SGD, rupee by SGD, and once you know rupee by SGD, it means rupee should be on the top, SGD on the bottom, and then accordingly you create your, then accordingly equations can be created. Once you've done this, then let's read question number 1. Let's read question number 1. Question has come 6-7 times in the exam. Says you sold HKD 1 crore value spot to your customer at 5.70 per HKD. HKD is Hong Kong dollar. You sold Hong Kong dollar. 1 Hong Kong dollar equal to how much? 5.70. Think about it. You sold Hong Kong dollar. In your pocket, what you have as of now? Rupee. When you sell Hong Kong dollar was confirmed 1 crore. Sold Hong Kong dollar. In pocket is what? Rupees. 5 crore 70 lakh something. And covered yourself in London market on the same day. It's not went to London. On the laptop you would have opened that market. On London market you covered on the same day when exchange rates were. Covered means basically I am a shopkeeper. You means I am a shopkeeper. Customer came to me and said I need Hong Kong dollar. Cake order. He gave me the cake order. Say I have birthday party, I need a cake. I would have given cake order to someone else. This is exactly what happens. So covering means you will buy from me, I'll buy from someone else. And I have given commitment to you 1 crore dollars. Now basic objective is you will buy from me, you are my customer, I am a bank. You will buy from me HKD how much? 1 crore. Chocolates you'll buy. Same chocolates I'll buy in which market? Interbank market. Now what I need to buy is, you will buy HKD from me and I need to also buy what? HKD. That means HKD is my chocolate. And what do I have in pocket? With which currency I'll buy as of now? Rupee. That means I need to find what? Rupee per HKD. What rate? Ask rate. Understand what I'm saying? Do not get confused please. You will buy from me. You will buy from me. I have given Hong Kong value spot to a customer. I have given the commitment to you. I'll give you HKD. I'll give you the chocolate. I'll give you the cake. In the evening I have to arrange for that cake. I am ordering the cake into some other shopkeeper. So from that shopkeeper I'll buy that HKD 1 crore. This is confirmed. And since you gave me rupees, I have rupees in hand. That means I'll buy HKD with which currency? Rupee. And which rate I need to find? Ask rate. Rupee per HKD, ask rate. Now problem is, you might wonder, actually student what make a mistake is, sir, you are a bank, you sold to us. When I sell to you, I would have applied what rate? Ask rate. I'll buy from something else. Then they start doing is, banks buying rates is bid rate. It's not that you asking me is ask rate. I am asking someone else is still the ask rate. You asking me is what ask rate? Merchant ask rate. And my asking is what? Interbank. Problem is you are buying from me ask rate, that you know it's perfectly fine. I am buying, they start assuming, sir, you are a bank. I never use the language in the quotation bank. I said quotation are from whose point of view? Seller's point of view. You are buying from me. I am a seller. I am buying from someone else. He is a seller. Still the ask rate would be applied. That means between him and me, ask rate will be applied. You asking me, question has already said. Now same thing I'll be asking. That means I'll be asking for HKD with rupees, rupee per HKD ask rate. And he has given dollar HKD. Now let me put down this way. No need to even write the quotations. He has given dollar is equal to HKD. This how do you write? HKD per dollar. And second movement I'll make is HKD is equal to what? Dollar na? Dollar by dollar per HKD. Then he has given what? Dollar and what relationship? Rupee. Dollar is equal to rupee. I'll write here what? Rupee by dollar. Next would be rupee is equal to dollar, that is dollar by rupee. And I know what I need to buy. Rupee on the top, rupee here, HKD on the bottom. Second. Which quotation will multiply? Second and third. And which rate I'll multiply? Ask rate. Sir, can we logically do? I can logically do. Actually, you know what I'll do? You gave me what? Rupees, na? With the rupee, I'll buy what? dollar. With the rupee, I'll buy dollar, and with the dollar, I'll buy what? Hong Kong dollars. Or second way is to buy Hong Kong dollar, how much dollar required? To buy those dollar, how much rupee required? Ultimately, it means to buy 1 crore HKD, how much rupees are required. Now, let me show you, because one example I'll ask you to do on your own. This let me show you once. Look up, please. I've done logically also and illogically also. That means in exam straightforward you can get the answer, and I always have a habit of writing what is exactly the feeling of the question so that you understand when you're doing in the exam. Since you sold, it's a bank, HKD 1 crore, to cover your position you will buy HKD in rupee, hence we need to find rupee per HKD ask rate. And please understand, bank is not buying from the customer, bank is asking in the interbank market, so I need rupee per HKD ask rate. So I will buy HKD and you will buy from me, transaction would be over. We were given what quotation? Dollar HKD. I'll create what quotation? HKD dollar. You were given dollar rupee. I'll create what? Rupee this. And I know on the top I need what? Rupee. On the bottom I need what? HKD. Now look up, please. Logically let me do it. What is my confirmed currency in the question here? HKD. HKD. To buy HKD, if I need to buy HKD, I'll go to some other shopkeeper, I'll say bank I need to buy HKD. So buying HKD, which rate he'll apply? Ask rate. He'll say bring these many dollars. He'll say bring these many dollars. I've done logically also. So when I buy HKD, he'll say bring these many dollars. Left to right when we go, I'll apply this. Left to right when we go, we do what? Multiply. So how many dollars required, sir? 13,17,870. Then since I have rupee in hand, then I went to some other bank. I said I need to buy what? Dollar. I want to buy dollar because to buy HKD I need dollar. Then dollar is a confirmed currency. To buy 13,17,870 dollars. To buy dollars I need what? Rupee. Hence second rate is 42.85. Actually, if you look at this also, you're multiplying these two only. The objective of this is to buy HKD you need dollars. Once dollar is a confirmed currency, to buy dollar you need what? Rupee. Once you multiply both of them, you get that cross currency rate, or you can say to buy 1 crore HKD you need $13,17,870. To buy these dollars you need rupee 564.7730. It's as good as to buy 1 crore HKD, rupee requirement would be 5 crore 64 70 lakh 730. When you divide, you will get the rate. It will come 5.6470. And when you multiply these two simply by the rule, this and this, you will get same 5.647. Same thing you will get. Understand the logic of it. I have done in the diagrammatical presentation also, please. It's as good as to buy HKD, how many US dollars required? To buy those US dollar, how many rupees required? And that is exactly what we are multiplying. The HKD rate and the dollar rate. To buy HKD US dollar, to buy US dollar, how much rupees are required? Now check this out. Very, very important. The examiner comments used to come, I think students used to take a bid rate, because they say when you are buying, bank is buying, it's a bid rate. You have to understand, customer buying from the bank is a merchant rate, bank buying from some other bank is asking. Both are asking only. You are asking me is a merchant rate, I am asking someone else, it's a interbank rate. And then he said, calculate the profit in the transaction. Profit would come as I sold you at 5.70 and I covered back myself in the interbank market at 5.6471. Profit on 1 HKD came 0.0529 and total chocolates are 1 crore. So I multiply 1 crore into 0.0529, it comes rupees. This diagrammatical presentation was just a logical understanding that when I went to the market to buy HKD, he said you need these many dollars. And then since I do not have the dollars, I went to the market to buy these many dollars. They said you need these many. Once you've done this, let me know. I'll give you one question. Self do it, please. Done? Question you will not have, so you will have to look from my book only. Then you'll do it. Question number 65. You can read from here. Now I'll read out the question with you. You are a foreign exchange dealer of your bank. Informed that your bank sold TT on Copenhagen for Danish kroner 10 lakh. Do not get confused which country this belongs to. Danish kroner is a chocolate. Someone has sold. One Danish kroner was sold for 6.5150. You are required you are required to cover the transaction. That means you need to buy what? Danish kroner. What is in hand you have? Rupee. In either in London market or New York market, the rates on the date are these, November 13. Now look up please. Mumbai London rates are given. That means pound is equal to rupee with an ask rate. I have written here rupee by pound. Mumbai New York is dollar rupee relationship, and this relationship is basically the pound with the DKK and dollar with the DKK. So what you have to do is, I divide into two parts. What you will do is, what you did in the Hong Kong dollar was a one market. In this two types will come. First, applying the first two quotations, pound rupee, rupee pound, dollar rupee, rupee dollar. You need to find what you sold what in the morning, DKK. By the end of the day you want to buy what? DKK. DKK is chocolate, and with which currency, sir? Rupee by. That means you need rupee by DKK ask rate. So one is cover yourself in London market. This is London market, and second market is basically this is basically covered this way. You'll cover this way. London rupee and London DKK. Using this and this you'll find one quotation, and using this and this you'll find second quotation. Find out please. So what you do is go to London market. 1 pound is equal to rupee, rupee is equal to pound, 1 pound is equal to DKK, and DKK is equal to this. Your objective is rupee per DKK. So use first and third to create 4 quotations. Use second and fourth to create second set of quotations in New York. Quickly try that out. Use the quotations accordingly. Set of numbers. Tell me any one numbers which you get the answer. 6.5079. That's Mumbai, London market basically. 6.5102. London market basic. Second market is this was which question number? 3, 5. So 65. £1 is equal to rupees 74.3000, and this was given. I got first answer as 6.5079. This was London market. So we used quotation number 1 and last one. Used first and the last one. Ask rate, and similarly profit made in the first part was you sold at 6.5150, bought at 6.5079. So on 1 DKK, that's one chocolate, you made 0.0079. On 10 lakh chocolates, you'll make 70,100. Similarly, in New York, again first and last will be multiplied, because dollar, rupee by dollar and dollar by DKK. Answer came 6.5102. In this case, profit was made 4800. First one profit was made 7100. Advisable to cover it position which market? London market, since it gives what? Higher profit. Was your answer. When you make the 4 quotation, in both of them, first and the fourth would come. First and the fourth one would. Done. Cross currency will come back again, I think. Now, before entering into a new concept, read 37th, a very general question. Make a framework of your answer. I'll take the answer from you. 5 minutes you spend. You have the answer. Try to create a question, whatever way you want to do. 37th. Answer is given to you, but I want you to spend time and make an understanding of what does it mean. This is a perfect case of left to right, and right to left. What does it mean? 5 minutes you spend, then I'll start off. It's a general question. Number 37. Due for a long time in the exam. Last time I think came in 2007 or 6. Number 37. Read on your own, please. Make a framework. What do you expect from it? He wants whose subsidiaries are there in US and UK, and parent is in India, I think. He says UK and US have surplus, India has deficit. Either we bring the UK US money today and merge together, or second part he says is what? That they merge after what point of a time? After 30 days. This is the crux of the question. This cash balances are to be merged after 30 days. One was this. That means there is a dollar, pound and rupee. Dollar remain in the dollar, earn something. 30 days, after 30 days comes euro, a dollar to you. Pound, earn interest on pound, earning is E is earning, and pound come, convert to rupee at a 30-day forward rate. Rupee remains in rupee. Since you are having a deficit, this deficit will be there and rupee would be there, and then you club all of them together. That means dollar you stay in your country, pound you stay back in your country, rupee you stay back in your country. After 30 days you merge. That balances are to be merged after 30 days. That's one part. Second part is cash balances are to be pulled immediately. Cash balances are to be pulled immediately. Dollar and pound are asked to come to rupee at spot rate. All three will become in rupee, and then interest on rupee. If it's a deficit, you make the payment of the borrowing charges. If it's a positive balance, you earn on this. Two objective of the question was cash balances are to be merged after 30 days time. That's one part, and second part is or cash balances are to be pulled immediately. That was the objective. And it's given, I think, rupee, dollar, rupee, pound accordingly. So be comfortable when you're doing it. He has given the answer to you, but when you're converting, be very comfortable, please. For example, says Indian based company has subsidiary in the US and UK. Forecast of surplus funds for next 30 days of two subsidiaries are given below. US dollar 12.5, UK 6 million. And then you have foreign exchange available. Spot rate rupee dollar given 0.0215. 0.0215, and 30-day forward is given 0.02117. Spot it is given 0.0419. Then you have borrowing and this rate available. Look up, please. I have done, I think, shortcut answer also. Look up. If you bring in 0 period, convert 12.5 into rupee. I think it will be divided by 0.0215. Yes, dollar na. 12.5 divided by 0.0215. 581.395. And if you bring pound in the 0 period, pound 6 divided by, this is here I have taken, pound 6 divided by 0.0419. That means 0 period will become equal to rupee 402.684. Rupee was already deficit somewhere 500 million. Add 500, I think 0 period you will have 484.079. This is pulled immediately. So I have taken the spot rate of the dollar rupee, spot rate of the pound, and then since you have a surplus, you will earn at what rate? Rupee earning rate is 6.2. 6.2 for 30 days. Your balance at the end should become 486.58. 486.58. What has been done? Please look up. 12.5 converted at the spot rate 0 divided by 0.0215. The 6 million pound converted at the spot rate 0.0149 plus India deficit was what? 500. Total becomes 484.079, and earning rate would always be lesser than the borrowing rate. Borrowing rate would be 6.4 here. The earning rate is 6.2. So you multiply by 6.2 and 30 days, you get to know if you pull immediately, your balance after 30 days would be 486.58. Second is after 30 days. So after 30 days when you do, you apply 0.0217 rate. No, first you do is you calculate the dollar equivalent. Dollar equivalent will come, I think, $12.5 plus interest on dollar. I think I am getting interest plus interest on dollar is 12.515625. And when you use the 30-day forward rate, you will be getting some number 576 point. This is dollar. Similarly, pound also do it. Pound was, how much pound you have? 6 million, na? First 6 million plus you will do 6 into pound earning rate is what? 3.7 into what? Into 30 by 360. How many pounds after 30 days? 6.0185. And this will be converted at what rate? Forward rate. This will be converted at divide by 1 divide by, that's divide by basically I say point 0.0150. How much you will get? 4012 401.23. Basically, if dollar stays in dollar, this will become 576.76. If the pound stays in pound, after 30 days it will become in rupee. And I think rupee borrowing already you would have. That's basically, this is after 30 days. Pound equal to rupee. This was dollar equal to rupee. Rupee loan was how much? 500, na? So rupee outflow is deficit is 500 plus 500 into, it's a very general question, no link with any kind of a concept. 360. How much do we get? 67. That's the deficit. So now you can add up 576 plus 401.23 plus 502.67. Basically what has been done, earning interest on dollar, earning interest on pound, deficit, then at the end convert back. When you convert back, basically pound, dollar, and total becomes what? I think 575 something, 475.32. When you add these three numbers, 1, 2, 475 point, and first one was giving us 486. It is advisable what? Pull immediately. So the very general question. Pull immediately. Objective of the question was basically to stay back in the respective country or pull immediately. If you stay back in your own country and come after 30 days, the net answer comes as 475 because dollar will earn some interest. That's the interest on the dollars. Dollar equivalent converted at dollar rate. It's a pound converted at the 30-day rate and the deficit. Above was basically 0 period, 0 period, 0 period clubbing together and then interest earning in Indian rupees 486 point. We have 38th question in your book. General question, try that also please. 38th recently came in the exam. 38th is a general question, try that also please. Try 38th. We'll focus only on the Japan part. The problem which comes or will come when you read at home. Says the following information relates to AKSA Limited, which manufactures some of the electronics device which are exported to USA, Japan and Europe on 90 days credit term. Japan, Europe 90 days credit term. Cost and sales information available. Japan, I am focusing on variable cost per unit 225, export 650 yen, and total is 78. 78 lakh yen divided by export price. Can I find the number of units? How much do we get? 12,000. So we get 12,000 units. That's not the challenge. Variable cost is how much? 225. 12,000 or 225? 27 lakhs. Sir, what exactly we need? We need the contribution. Average contribution is basically contribution nothing but sales minus variable cost. I need in Japan, US and Europe by applying 3 months forward rate and then calculate what is my contribution by sales ratio which comes out average, and then without doing anything, no hedging, you want to check which one is better. My objective is not the entire question. Problem is I get contribution in sales minus variable cost. Exporter, importer, exporter. So using units sold variable cost per unit, you got the variable cost. Now what do you need to calculate contribution? Sales, na? Sales are given in what? Yen. You will, let's suppose you use 3 months forward rate. Let's suppose he says either use forward rate or no forward rate. Whether it should hedge or not means using a forward rate calculates contribution by sales. Without using a forward rate, calculate contribution by sales. Let's use a forward rate to calculate sales. I would apply which rate? You are exporter. You will sell or buy? You will sell or buy, exporter? Sell. I will do what? Buy. Which rate to apply? Bid rate. Problem is he has applied ask rate. Understand the problem, please. This problem will remain when you go back home also. The objective is we need to find contribution. Contribution depends on sales and variable cost. Variable cost per unit was given. Using the above data, we calculated what? Units. Unit into per unit variable cost came. Sales would be in 78 lakh yen. So converting 78 lakh yen, you are an exporter. You will do what? Sell. I will do what? Buy. To buy, which rate I will apply? Bid rate, but he has applied the ask rate. What he wants is he wants to apply the forward rate, and then without applying the forward rate is not hedge and then calculated. Means basically hedging tool, forward contract or no forward contract. But my question is not the forward or no forward, that you can do. Why has he applied this rate? Now whenever you solve, I'm again saying what you will do is, now look at this, what I do it here. The receipts are 78 lakh yen, export you calculate 12,000, this you've done, into 25 you go 2 lakh 27 lakh. Is it fine? 3 month forward rate is given, 1 rupee is equal to yen, whereas confirmed currency is what? Yen. The moment you write yen here, the rate is same. In exam, do not look at that was your institute answer which I have shown you. They'll write this way only, and then you say forex becomes difficult. It is not difficult at all. Keep your basic rule very clear. Whichever currency is confirmed, keep on left hand side, because you are dealing in what? Yen. Actually, rupee can have a bid and ask rate. Yen can have a bid and ask rate. You need the rate with respect to which currency? Yen. Similarly, if I would have taken second US, you need the bid rate of which currency? Dollar. So bring dollar on what side? Left hand side. Automatically things will change for you. I hope you are getting my point. So it was yen was confirmed currency. Bring on yen what side? Left hand side. When you move from left to right, you will do what? Sell. I will do what? Buy. Apply this rate only. So when you look at the rate, you were given the first rates. You are not selling or buying rupee. Means you are not dealing in rupee. Confirmed currency for us was yen. Yen left to right. I'll apply this. So my sales will come in accordingly. Same way I'll calculate my dollar. I'll calculate for the third currency with using a forward contract, then contribution by sales. Similarly, if I do not hedge myself, again the same data, and which one is better. The rule has to be very clear, please. Confirmed currency on the left hand side to right, left to right, you will do what? Multiply and make sure, because both currencies can have bid and ask rate. You have to identify for which currency you need bid and ask rate. So confirmed currency on the left hand side, whichever is confirmed. Now you see you want to buy or sell. If you want to sell, I'll buy. If you want to buy, I'll sell. Accordingly, we can apply this. Is it fine? That was again a basic question, came recently in the exam. 38. Will not do anything else because I'll cover up something new tomorrow with respect to this. So we'll wind up here. That's the objective. I'll show you something because I told you in the beginning I wanted to cover up the derivative today because it would have become very, very interesting topic if I would have covered, because you never see this kind of a day every day. This kind of scenario never comes in the life every day. This is the danger of the FNO market. Idea board meeting happened yesterday. Very big announcement came, but the share price fell approximately 14%. Now don't be worried, it's a normal game together. When good news comes, share will fall because everyone would have bought and they sold off. Last week, 3 days back, it was 18 point something, today it's 14. For you, it's a 13 and 14. Since it's almost a 1 day before the expiry, tomorrow we have expiry, last Thursday of the month expiry happens, the new contract comes in. When I go to the derivative market, I'll show you something very interesting in the option market. The option markets, let me look at something. Let's put down, yesterday price was around 15.78 something and 15 rupees put, let me see, 15 rupees put. If you look at, this is 15 rupees put price, the strike price is 15. We'll cover in the option market because that time the screen would not be there. Opened at what paisa? 25. High was 160, low was 10 paisa, and it jumped up 540%. That's almost 5 times of what was the close yesterday, 0.25. If you look at what was 10 paisa, 14 rupees, the price became 70 paisa, 600. And it is not about, that means 6 times in a single day. It is not about them only. Some of the, because market have fallen, so put option would be giving lot of money to you. And if you look at the call options, the value declines drastically. Now it might be not very interesting for you, but anyone, for example, if I look at 14 only, someone would have sold yesterday 10 paisa, let's suppose 80,000 lot size, writer case I am taking, he would have made 8,000 inflow, but today from his pocket he would have given 60 into 80, 48,000. The single lot I am talking about, it's a 80,000 lot. Idea is 80,000 lot. So they were totally messed up. In a single day, loss could be 10 lakh, 20 lakh, 15 lakh, earning could be only 10,000, 12,000. A writer case. But this happens once in 12 months time. When holder says I'm making money, and today no one was able to make a money. 9:15 it opened up. Quickly from 570, within a fraction of second 510. Then fraction of a second it went to 16, 17 rupees, higher side, 16 point something. To the chart if I can show you, because this kind of a thing you cannot catch up even if you want. And then I went with my mother to hospital, and by the time I came back I came to know something has happened. Don't ask me the loss. Now this opened actually here, and then it went up and then it came down, and this will, now tomorrow no one knows if the big players have made a big position. You might see intraday coming to 12 and then same day it can become 15. So you cannot play around with the option market. Option market is such a dangerous market which can make you go bankrupt in a single day. In a single day, it does not require. So, and this is with put option I've showed you. Na? I was trying to find out, I was not able to find out. In July month we had, because I was showing with doing with the finals that time, the chapter. I'm not able to get where is my idea screenshots. I don't know, because I save these kind of screenshots. These screenshots are very important. This screenshot I'll save because a very rare time it happens. Like I don't know where I saved. The main file I have, I'll show you that screenshots. Means this kind of a market can make you go bankrupt in a single day, and especially the expiry days. Expiry days are very crucial. In a normal size, no one would have lost. 10,000 share you buy, 20,000. How much loss will come? 10,000 rupees, 20,000, 30,000. But if you're a writer, you'll get paid up. Last week I remember when it went to 18.5, the 16 or 17 put was trading at maybe a 10 paisa. It was almost expiry was 3 days. Now the 17 10 paisa item, now it came down to 14, 3.5, 3.5 rupees. That means 35 times. Those who would have bought, it's very difficult. And if by chance the general retail public would have bought, and how much transaction happens in idea, this is actually some it's very difficult to make money in this counter. I don't know. For the history I have seen, it's very difficult. You cannot even imagine the movement of this stock. If I show you how many crores the transactions takes place in the option market, let me show you this. You cannot even imagine the kind of transactions, quantity buying selling happens. The volume they give, but it's actually difficult to multiply. Otherwise, in 100 crore. In fact, idea share itself, if you look at in the cash market, if you try to look at the cash market transactions, you'll be surprised. 158 crore share transacted. 1 crore 58. And you know, how do you come to know whether the fall will come or not? But this fall was not expected. Fall was expected because there is a pre-open 9 to 9:15. When a pre-open happens, generally you will find trading of the share will happen 3 lakh share, 4 lakh. It opened today, I think. Yesterday close was 13.65, and it opened was 15.50. No, yesterday close was 15.85. Look at this. This was the close, opened at 15.50 today, and there was a selling of 1.45 crore shares. That gave indication something will happen, but this kind of scenario was not available. I thought he'll eat away the premiums of maybe 16 rupees call and put or 15 rupees. He made sure 16 is gone, 15 is gone, 17 is gone, 14 is gone, now 13 and a half. Now tomorrow their wish, whether 12.5 or 14.5 or 14 or 15. And surprisingly, no matter what happens tomorrow, Friday things will drastically change, because new expiry comes in. And the moment new expiry comes in, automatically you will come to know that again the premiums play will come into picture. So next expiry, what was trading for the 17 rupees put, that moment happened 2.5 to 3.5 or 3.8. But for this month expiry, it was 30-40 paisa item, which meant to up 0.5. So somewhere means the premiums were very low, and the buyers have made huge money. But no one expected after that kind of a news, because the news was very positive, and that's why I say the general phenomena which market follows is buy on rumors and sell on news. But this was not expected from here. They have made ample enough 45,000 crore fundraise, and then some brokerage houses came. So this is not enough money. I don't know what is enough money. 45,000 crore. But anyhow, the problem was, this was again a new board resolution has come. This came, I think, 2 years back also. Maybe that could have been something. And with this kind of a news, if the share price falls, that means it was very serious. And the board meeting now is, shareholder approval will be 2nd April. So even the big players know nothing will happen in the month of March. Someone who would have bought at the higher side, they'll remain stuck for some time now. You never know what side it goes. And I am worried about my number now. What happened with the number? Very dangerous part. When you enter the market, FNO, be very careful. As a holder, it's okay. If you lose out small amount, but as a writer, everything can go in a single day. What you earn in 11 months, it's only a 1 day period. Single day it can happen. This did not happen with this share. If anyone follows Z, they would have seen with the Z also, when the deal was announced, deal will happen, the way it moved up. When deal was rejected, the way it fallen down. So if you are in the call and put side, and if you're writer or even a single lot you are there, if idea 80,000 lot you would have bought last week, by today you were 4-5 lakh down, single lot, not require anything else. So it's a very dangerous market. Cash market is not that. Cash market is basically your own money. You know how much you can invest because you are not allowed to do it. Be careful in this. It was today, since the movement happened. We'll be covering this topic in the regular classes. Derivative will come as a part of your course. Cover up. It came today, so I thought I'll discuss with you. Take care and bye bye. No advice to buy or sell. Derivatives are very dangerous market. 90% people lose money when they invest. Take care. Bye bye.